Welcome to the Deep Dive, the place where we sift through your sources, find the essential knowledge, and deliver the insight that makes the information stick. Today, we are sinking our teeth into an asset that most people in the middle class use every single day. They live inside it, they pay for it, but they rarely think about it as the single massive economic force it truly is.
Yeah.
We are talking about home equity.
It's such a foundational concept. It is so much more than just, a quick calculation you run when you're thinking about putting your house on the market. Home equity, particularly in the U.S., is really the definition of wealth for the majority of citizens. Our analysis shows that this single, powerful, yet illiquid asset, it forms the economic backbone of the entire global middle class. And in the United States alone, the total equity held by homeowners is staggering. It's topping $35 trillion as of the start of 2025.
35 trillion. That's a number that's so big, it almost doesn't mean anything. It's just abstract.
Yeah.
It represents the value that's locked up in the American dream, sure, but also the Australian dream, the Canadian dream, really the aspirations of families all over the globe. So our mission today, and this is tailored specifically for you, the listener, is to really understand this asset intimately. How is it built? How does it stack up globally? And I think most importantly, how has the financial world designed these incredibly complex tools to unlock this illiquid but absolute vital store of value?
And to really do the complexity, we have to start with the basic math, the foundation. So what is home equity? We can boil it all down to a very simple accounting identity. Value minus debt equals equity.
That's it?
That's it. It's the homeowner's unencumbered financial interest in their real property. It is the part of your home's current market value that is truly yours, free and clear of any loans or mortgages.
And here's the most profound thing, I think, right out of the gate. This is the fact that frames this entire conversation. This massive asset is the single primary strategy for the American middle class, and you could argue the global middle class, to build household wealth. For most Americans, their home isn't just their largest asset. It often accounts for more than half of their entire net worth. So when you are looking for the source of wealth accumulation for the average U.S. household, you are looking directly at home equity.
Okay, so let's unpack that. This engine of wealth. Let's start with the mechanics of how this immense value is actually created, because it's not just a matter of, property values going up. It involves real commitment.
Right. So if the math is value minus debt equals equity, where does that initial value come from? Is it always just the market appreciating?
Yeah. That's a great question. And no, it's not just appreciation. There are two primary, very distinct ways that equity is acquired. The first one is immediate. It's straightforward. It's the direct purchase. When you walk into that closing with your down payment, say it's 20%, you are instantly creating equity in that exact amount the moment you sign the papers.
So that's your skin in the game.
That is your stake, your unencumbered interest, right there on day one.
And the second way is the one that happens so slowly, often without the homeowner even realizing it day to day. That's the long-term growth through payment and appreciation.
Precisely. Equity grows in two ways once you actually have the loan. First, it grows every single month with the standard amortizing loan because a portion of your regular monthly payment is applied to reducing the principal balance.
Which shrinks the debt side of our equation.
Exactly. In the early years of, say, a 30-year mortgage, those principal payments might feel tiny, but they accelerate over time, building equity faster and faster as you go.
And the other side of that, the market forces.
That's where appreciation comes in. The value side of the equation expands. It grows when the property's fair market value goes up due to inflation, maybe the neighborhood improves, or just market demand, all while the debt you owe stays the same or, keeps shrinking from your payments.
So you're hitting the equation from both ends.
You are. You're shrinking the debt and you're expanding the value. Both of those activities increase your equity, often pretty dramatically, over a decade or two.
This mechanism, though, this growth, it leads us straight to the core problem, the one that has launched 1,000 financial products, the paradox of illiquidity. We established that home equity is, $35 trillion in the U.S. alone?
Yeah.
A gigantic pool of wealth. But as you said, it's entirely illiquid wealth.
That is the absolute essence of the paradox. I mean, imagine your entire net worth is stored in a huge, heavy safe in your basement. You know you're wealthy, you can see it on paper, but you can't use that money to buy a car or pay for college or handle a medical emergency directly.
It's wealth on paper.
Secured by the property, yes, but it is not spendable cash.
So if I need that wealth, I can't just write a check against my equity. What are the steps? How do I convert that paper wealth into actual liquid, spendable funds?
You have to, by necessity, take one of two big steps. The most obvious one, and the one with the most friction, is you sell the property outright. That triggers the sale, the debt gets settled, and then you receive the remaining equity as cash. The second path, and this is the one that drives the whole financial industry we're going to talk about, is you have to use specialized financial products that use that equity, the value, as collateral for a new loan.
Either way, it's not simple. It requires friction, cost, and a formal transaction to unlock it.
Right, and what happens if the market reverses course?
Exactly. If appreciation is one of the main drivers of growth, what happens when the housing market turns the other way, like we saw 15 years ago? That brings us to what you call the dark side, negative equity, or underwater mortgages.
This is where that simple math becomes just devastating for the homeowner. Negative equity happens when the property valuation declines so much that the total debt on the main mortgage plus any other loans is greater than the home's current market value.
You're literally underwater or upside down.
In your primary asset, yes.
And it's so easy to just dismiss that as an accounting problem, but it has these enormous real-world implications, especially during a crisis. Can you give us a sense of the scale of this problem when the market crashes?
We only have to look back to 2012 in the aftermath of the subprime crisis to see the sheer destruction of equity. Our sources show that roughly 20% of all U.S. mortgage holders were underwater at that time.
1 in 5 homeowners.
1 in 5 owed more on their house than it was actually worth. And the concentration of this was just brutal in states that had the biggest housing bubbles.
Oh, you see states like Nevada leading the charge with a shocking 61% of mortgages upside down. Arizona was at 48%, Florida at 44%. I mean, that means in a place like Las Vegas, more than half of all homeowners were looking at their largest asset and realizing it was actually a massive liability.
And here's why that is so critical for financial stability. It drastically increases the risk of foreclosure and default. If you, as the homeowner, try to sell your home, the money from the sale won't be enough to cover the full debt you owe the lender. If you're underwater by, say, $50,000, you have to bring $50,000 in cash to the closing table just to get rid of the house.
And if you don't have that cash, you're just trapped.
You're completely trapped. The homeowner has no financial stake left in the property. And, behavioral finance studies suggest that in these situations, the homeowner is often incentivized to default, especially if they're facing other financial stress because they feel like walking away actually minimizes their future losses.
That massive loss of incentive.
That's what created the systemic risk during that 2008 to 2012 period.
Moving on from the core mechanics, let's dive into what this asset means for the country as a whole, specifically the American experience. Wealth disparity and generational transfer. When you look at the economics, this is where the conversation gets really, really interesting.
It absolutely defines the socioeconomic structure of the American middle class. Home equity accounts for a massive 43% of the net worth for the median U.S. household. And if we drill down even further into the 3 middle-income quintiles, the true middle class, that share jumps even higher. It represents between 50% and 70% of their total net wealth.
Wow.
That is an enormous reliance on one single illiquid asset.
Wait a minute. When you put those numbers side by side, it sounds like homeownership isn't just a route to security, it's almost the only functional route for most of the population. Are our sources saying that this overwhelming reliance on a single, potentially volatile asset is actually a societal risk, even while it's creating wealth?
It creates a tremendous disparity, which is exactly the societal risk you're pointing to. I mean, consider the consequences of this reliance. The median net worth for homeowners was about $400,000 in 2024. Now, compare that to renters. Their median net worth was just $10,000.
$10,000?
That difference is almost impossible to overcome through just traditional savings alone.
And that gap isn't static, is it? The data shows this disparity has nearly doubled. It grew by about 70% between 1989 and 2022. So the sharp rise in home values and the differential opportunity to build equity, that contributes directly to this record wealth disparity between those who manage to buy and those who are forced to rent.
Which is why we call homeownership a forced savings plan. This concept is just central to understanding the American dream. If you have a traditional retirement savings plan like a 401k, it's voluntary. You can choose to contribute or you can choose to stop. But a standard amortizing mortgage, it compels you to pay down principal every single month. You are building wealth through that principal reduction, regardless of your personal savings discipline or, lack thereof.
It's a mechanism that literally forces you to save the largest single chunk of money you will likely ever acquire. And this forced savings plan is also inextricably linked to generational transfer.
Absolutely. Think back to the post-World War II environment. Programs like the GI Bill were instrumental in accelerating this whole process. The bill didn't just provide tuition money, it provided government-guaranteed low-interest home loans with zero down payment requirements.
That's incredible.
This wasn't just a financial program, it was a social engineering tool.
So that low barrier to entry, combined with the explosion of the suburbs and the incredible post-war economic growth, that just allowed for this massive, unprecedented accumulation of home equity by an entire generation.
And that accumulation was then transferred to the next generation, either through, cash inheritance when the home was sold, or by giving the next generation a lower cost entry into the housing market themselves. The broad home ownership that was established by the GI Bill really solidified the post-war middle class and became the primary way for intergenerational wealth to accumulate in the U.S.
And we can see the culmination of this forced savings effect so clearly when we look at home equity across the life cycle. If your home is your primary source of mandatory savings, what happens when you finally reach retirement age?
It results in a very pronounced and a very stark financial pattern. Older homeowners who have spent decades paying down their mortgage and benefiting from appreciation, they often have substantial unencumbered equity. Conversely, renters who haven't had that forced savings mechanism tend to have very low wealth later in life.
So the wealth gap between homeowners and renters, which is fueled by this generational equity building, it peaks right around retirement age. And it's why accessing this equity through the special products we're about to discuss becomes an absolutely crucial element of retirement security for millions of older Americans. The security is there, but they have to figure out how to unlock it.
So the U.S. experience is one of high reliance on home equity as a wealth engine. Now let's take this deep dive global, because the U.S. is far from an outlier in seeing high ownership rates, but the way that wealth is concentrated and valued, that changes wildly depending on the market.
Okay, looking at comparative ownership rates, it's clear that high ownership is the norm, not the exception, across the developed world. The European Union, for instance, it averages about 70% of the population living in a household that owns their primary residence.
But the contrast inside the EU is fascinating. You have countries like Romania, where the homeownership rate is astronomical, over 95%.
95%.
How? Well, this often reflects a history of transferring state-owned housing to tenants at very low cost after political changes, which created this near-universal ownership.
And then, at the complete opposite end of the spectrum, you have Germany. Germany stands alone as the only EU country where homeowners are actually a minority. Their rate hovers just below 50%. Why is Germany so different?
Germany has historically had extremely strong legal protections for renters. It often makes long-term renting a highly stable and attractive alternative to buying. And culturally, there's also a preference for professional mobility, and the tax structure often favors rental investment over speculative ownership. So while ownership is still important, the lack of pressure to buy means home equity is not the sole determinant of middle-class success there.
The UK also fits this high ownership profile at 65% overall. And here's a fascinating nugget from the source data, relating back to our previous point on the life cycle. Owner-occupiers age 65 and over in the UK hold a record estimated $2.6 trillion of net housing wealth.
That's almost all of it.
That's nearly all the housing wealth held by that entire age group.
And that just confirms that the forced savings function we saw in the U.S. plays out almost identically in the U.K. It creates this massive concentrated store of wealth held by retirees, which is why the U.K. market for these equity release products is growing so rapidly. Older homeowners need to access that $2.6 trillion to fund their later life expenses.
And we see similar high rates in the Commonwealth nations, too. Australia is at 66%, where housing wealth is almost half of all Australian household wealth. And Canada is at 66.5% as of 2021, with its own specific market pressures.
But to truly see wealth concentration in action, where property just utterly dominates household finances, we have to look to Asia. Let's dive into wealth concentration in Asia.
China is the most stunning example. The homeownership rate there is exceptionally high. It hit 90% in 2020. That's virtually universal ownership.
And the economic consequence of that is just monumental. Our sources show that between 70% and 85% of all of China's household wealth is stored in its property market.
Okay, stop there. 85%. That means for the typical Chinese family, if their home price dips even 10%, they're losing a huge proportion of their total net worth. This level of concentration makes the stability of the housing market a top-tier national economic concern. It's the financial stability of the entire middle class bundled into one asset class. Why such intense concentration?
Well, historically, China has lacked the deep, diverse, and accessible investment alternatives, like sophisticated stock and bond markets that are common in the West. For the average urban resident, property just became the primary, the most accessible, and frankly, the most trusted vehicle for storing and growing wealth.
Then you look at Japan, which is highly developed but different. The owner-occupied rate is 62%. What's unique about their market, according to the research, is that housing prices largely reflect the price of the land the house sits on. How does that change the equity identity?
That's a crucial distinction. In many Western markets, the value includes both the structure and the land. In Japan, the structure itself is often seen as a rapidly depreciating asset. It may only have a functional life of 20 to 30 years before it's demolished and rebuilt. Therefore, the long-term, stable, appreciating part of the calculation, the value side of our equation, is almost entirely the land beneath the structure.
So if the building's value is constantly shrinking, the homeowner's equity is much more dependent on just holding a valuable piece of land in a desirable location. The building itself is almost a temporary investment.
Precisely. It changes the entire dynamic of how equity is built and maintained. It focuses wealth creation on the scarcity of land rather than the improvements made to the home, which is a stark contrast to markets where home renovation can aggressively increase value.
Now let's pivot to changing trends in economic stress, because these ownership rates are not static, and the rising cost of entry is having major social consequences, particularly for younger generations.
Take Canada. It has seen its rate decline steadily from a peak of 69% in 2011 down to 66.5%. And our sources point directly to the hardest hit group, young people who are increasingly being priced out of major urban centers. This decline is happening amidst rising housing prices, which are fueled in part by high immigration rates concentrating demand in already tight markets.
For the average Canadian household, home equity represented 42% of their total wealth in 2023. So this exclusion means that younger generations are being actively cut off from the primary wealth accumulation strategy in the country. That is a massive structural barrier.
And New Zealand shows an even more rapid and dramatic decline. Ownership has fallen from a peak of 74% in 1991 to 67% in 2024. And here's the deeply worrying projection. Based on current trends, the rate could drop all the way down to 48% by 2048.
If that materializes, that means the majority of New Zealand households will be renters in just over 2 decades. That fundamentally rewrites the social contract and the traditional structure of wealth accumulation in that country. It creates enormous policy pressure.
And finally, let's touch on South Korea, which highlights the specific demographic stress created by soaring prices and economic stagnation. The overall ownership is a respectable 61.3%. However, when you drill down into young households, where the head of household is under 35-30, only 13.2% own a home.
Only 13%.
That is a steep, sharp decrease since just 2017.
This level of exclusion has led to these powerful and, frankly, heartbreaking social labels. Young people struggling with this are being described as the generation of house poor. And those who are truly struggling due to a lack of inherited capital are called dirt spoons.
The term dirt spoons is a devastating reference to the lack of parental wealth, the absence of that generational equity transfer we talked about, which has made homeownership effectively unobtainable for them. It's a clear global illustration of how the widening wealth gap, fueled by inaccessible home equity, is damaging social mobility and creating this generational economic anxiety.
We have spent a lot of time establishing that home equity is this colossal immobile asset pool, trillions and trillions locked up globally in brick and mortar. Now, we shift to the engineering. How do financial institutions and homeowners convert that illiquid security into spendable cash? This starts with defining home equity management and extractable wealth.
Home equity management is quite simply the process of tapping into that equity. It involves using the illiquid property value as collateral for new loans, often at favorable rates because they're secured, so the funds can be used for investment, debt consolidation, or other large expenses.
The scale of this opportunity in the U.S. is just immense. Homeowners collectively hold $17.8 trillion in equity. But what's truly relevant to the financial markets is the extractable portion. Our sources note that $11.6 trillion of that is deemed extractable while still maintaining a safe, conservative 20% cushion of equity in the home.
And that $11.6 trillion, that's the market opportunity. These are the home equity release products. Their entire singular function is to solve that paradox of illiquidity, converting stable housing wealth into usable funds delivered as lump sums, lines of credit, or even income streams.
Let's break down the two most traditional and common products in the U.S., which are both secured debt instruments. The home equity loan, or HEL, and the home equity line of credit, or HLOC. Let's start with the home equity loan, HEL.
The HEL is very straightforward. It is a closed-end, fixed-term loan. Crucially, it's a second mortgage, meaning the home equity secures it. It's closed-end because it can't be accessed again once it's repaid, and it has a defined term, often shorter than the primary mortgage.
And the key structural points are all designed for predictability. The disbursement is a single lump sum delivered at closing. The repayment schedule is fixed, so you have equal monthly payments over the term that cover both principal and interest. And the interest rate is usually fixed, which offers the borrower complete budgetary predictability.
As for its uses, our sources highlight three main categories. Roughly one-third goes towards home improvements, which is often still tax-deductible. Another one-third is used to pay off other non-mortgage debt, like student loans or credit card balances. And about one-fourth goes toward what they call personal consumption expenditures, or PCE, which just means general household spending.
Okay, now compare that to the home equity line of credit, HELOC. This is a fundamentally different kind of product because it is an open-end revolving credit line. You should think of it more like a massive secured credit card or maybe an overdraft facility.
The structure changes everything. The borrower doesn't receive a lump sum up front. Instead, they're approved for a maximum credit limit, which is dictated by the CLTV ratio, the combined loan-to-value ratio. This ratio looks at both your primary mortgage and the potential HELOC debt against the home's value.
So if my home is worth $500,000 and I owe $200,000 on the mortgage, and the bank approves me for an 80% CLTV limit, what does that mean in simple terms?
It means the bank is willing to lend up to 80% of your home's value, which is $400,000. Since you already owe $200,000, your maximum combined debt can be $400,000, so your available HELOC limit would be $200,000. And the beauty of the HELOC is that the borrower draws funds as needed, uses them, repays them, and can draw them again, all up to that limit.
And the interest rate structure is also very different.
Yes. The interest rate is usually variable, often based on the prime rate plus a margin, which means your payments can change monthly if the Federal Reserve moves rates. Crucially, interest is only paid on the outstanding balance you've drawn, not the maximum limit you were approved for.
That provides immense flexibility. That's its main appeal.
It is, but there's a timeline split that can really trip up unprepared borrowers.
Yes. There are two phases.
Absolutely. The HELOC term is split into two defined periods. First, the draw period, typically 5 to 10 years, where you can borrow and repay freely. During this time, you might only be required to pay the interest on the money you've used. Second, the repayment period, which follows that, and is often another 10 to 20 years. During this time, the line of credit closes, and you must begin repaying both principal and interest on whatever you owe.
Or sometimes you can face a large balloon payment if the terms were interest only during the draw.
Which can be a major financial shock if you're not ready for it.
Beyond those traditional loan products, we have some specialized release mechanisms that are tailored for specific financial situations. One of the simplest ways to unlock equity is through cash-out refinancing.
This is really popular when interest rates are favorable. The mechanism just replaces your existing primary mortgage with a brand new, larger loan. The difference between the new, larger loan amount and the balance of the old loan is the equity you cash out and receive as liquid funds.
It's effective, but it does reset the clock on your primary debt.
Then you have the product designed almost exclusively to address that life cycle problem we discussed earlier, the need for retirement income. That is the reverse mortgage.
Reverse mortgages are very distinct.
They are. They're typically available only to older homeowners, usually 62 or older in the U.S. A mechanism provides funds as a lump sum, a credit line, or a steady income stream based on the home equity. But the defining feature is that there are no required monthly principal or interest repayments during the homeowner's lifetime.
As long as they live in the home and keep up with taxes and insurance.
Right. And that's a critical difference for retirees who are living on fixed incomes.
That absolutely is.
The loan, which accrues interest over time, is only repaid upon the homeowner's eventual sale of the property or move out or death. These products are highly regulated, often government-insured, like the U.S. Home Equity Conversion Mortgage, or HECM program. That insurance protects the borrower from owing more than the home is worth, which ensures their heirs aren't saddled with a deficit. It's a key tool for improving retirement security.
And finally, we have the newest entry to the market, the home equity investment, HEI. This is a very different beast because it isn't secured debt. It's an actual financial contract that dilutes your ownership stake.
In an HEI, an investment firm provides the homeowner with a lump sum today in exchange for a pre-agreed share of the home's future appreciation. Like the reverse mortgage, there are no monthly payments required. The investor gets repaid their initial advance plus their agreed upon percentage share of the appreciation when the house is sold or at the end of the contract term, which is typically 10 to 30 years.
This sounds attractive because there are no monthly payments, but I know the critique is fierce. What's the potential risk that our sources point out with the HEI model?
The critique really centers on the math and the long-term impact on the homeowner's net worth. Let's use a simple example. A firm gives you $50,000 for a 10% share of future appreciation. If the house value doubles from $500,000 to $1 million, the appreciation is $500,000. You now owe the firm your $50,000 advance back plus 10% of that $500,000 appreciation, which is another $50,000.
So you pay $100,000 to get the initial $50,000. That's effectively a very high cost of capital.
Exactly. The risk is twofold. First, the firm often calculates their ownership percentage based on today's appraised value, which can be conservative, meaning they benefit disproportionately from strong market growth. Second, and this is the big one, the homeowner is giving up their future upside. The HEI reduces your future equity potential, the very security you rely on in exchange for immediate liquidity. For an informed audience, the HEI represents the highest philosophical cost of unlocking this illiquid wealth.
Now that we understand the products, let's focus on the HELOC. It has played a dramatic and, frankly, often destructive role in recent economic history, starting with the HELOC boom and bust in the United States.
The early 2000s saw HELOCs become wildly popular. What were the key drivers that pushed these products into the mainstream, making them almost ubiquitous?
There were two major drivers. First, the banks heavily promoted them. They were high-margin products secured by appreciating assets, and easy credit standards meant high limits were readily available. And the second one was the big one for the consumer.
Exactly. The interest paid on a HELOC was typically deductible under federal tax laws. This gave them an irresistible tax advantage over high-interest alternatives like credit cards, making them the default choice for consolidating debt or funding large purchases.
This confluence of easy credit and tax incentives created a massive market expansion. But how did HELOC abuse specifically feed into the subprime mortgage crisis?
The connection is direct and structural. Many risky subprime first mortgages were accompanied by high-risk ILOUs, known as piggyback loans. These allowed borrowers to avoid private mortgage insurance by keeping the first mortgage LTV at 80% while funding the remaining 20% with a second lien amendment HELOC. When housing prices crashed, starting around 2007, the collateral, that illiquid equity, it just suddenly evaporated.
So the HELOC became the second major wave of failure.
That's right. The HELOC was a junior LELO. It only gets paid after the primary mortgage is satisfied in a foreclosure. With negative equity rampant, the first lien holder might recover some money, but the HELOC lender often received nothing. The massive increase in second lien losses was a huge component of the bank failures and systemic distress.
And the 2008 reaction was swift and devastating on the borrower side. Major lenders, Bank of America, JP Chase, Wells Fargo, they all began freezing, reducing, suspending, or just outright rescinding credit lines.
This was pure self-preservation. Banks used dynamic risk assessment. As housing prices fell, they saw the collateral shrink and the risk of default skyrocket. They had the contractual right to reduce the available limit, which they did aggressively to protect their own balance sheets. And this move left many consumers suddenly without the liquid funds they had counted on.
And just when the market had stabilized years later, another key structural change occurred with the passage of the Tax Cuts and Jobs Act of 2017.
This was a seismic shift. Post-2017, HELOC interest is no longer deductible under federal income tax laws unless the loan is used specifically for substantial home improvement.
Like adding a bedroom or replacing a roof.
Right. Using it for credit card consolidation or vacation, no tax deduction. This eliminated a major incentive that had previously driven the product's use as general consumer debt.
Now, the Canadian HELOC market followed a similar rapid growth trajectory initially, but its post-crisis history is a study in stabilization through proactive regulation. Let's look at Canada's stabilization through regulation.
Canada saw really rapid growth in the early 2000s. The HELOC market expanded by 20% annually, and its share of non-mortgage consumer debt just exploded. It grew from 10% to 40% in a few years, essentially becoming the consumer debt instrument of choice.
Also fueled by low rates and rising property prices.
Of course. But unlike the U.S., Canadian growth slowed considerably post-2008, stabilizing at about 2% annual growth. Why did they manage to mitigate the systemic risk that crashed the U.S. market?
It's directly attributable to the government taking regulatory action. They were aimed at mitigating risk before the market exploded out of control. The Canadian government made 3 key moves that restricted bank risk appetite.
What were the key regulatory levers they pulled?
First, HELOCs were made ineligible for government-backed portfolio insurance, which forced lenders to assume the full risk themselves. It discouraged high-risk lending. Second, and this is the most important one, the Office of the Superintendent of Financial Institutions capped the maximum loan-to-value LTV ratio for HELOCs at a stringent 65%.
A maximum LTV of 65%. Let's break that down. If the home is worth $500,000, the absolute maximum secured debt you can take out on that home is $325,000. That is much, much stricter than the 80% or sometimes 90% CLTV ratios we saw in the U.S. pre-crisis.
It is a deliberate, strict measure. It ensures the homeowner always maintains a significant buffer of equity, which makes the product much safer. And third, underwriting rules were just made uniformly stricter across the board. These regulations ensured Canadian banks did not repeat the high-leverage lending practices that caused the collapse south of the border.
Shifting across the Atlantic, we see a historical lag in adoption, particularly in the UK. Let's look at the UK fintech shift. Historically, the UK often replicated U.S. financial innovations, but HELOCs were slow to arrive. Why the delay?
Partly because the UK banking system is highly consolidated. A few major clearing banks dominate the market, which can limit product innovation among the established lenders, and partly because they have other secured debt alternatives.
That all began to change rapidly after 2020. The first UK HELOC product was finally launched in 2021 by a fintech firm.
And this is a perfect example of how fintech can push innovation past these entrenched legacy systems. Consumers clearly wanted the flexibility because the adoption was rapid. Annual originations increased fivefold, going from about $50 million in 2021 to $250 million in 2022.
It's a huge surge, but it's worth noting the existing alternative they had. Offset mortgages, offered by institutions like Yorkshire Building Society, have been common in the UK for years. An offset mortgage allows you to link your savings account to your mortgage, and the savings balance is offset against the principal, so you only pay interest on the net figure. It provides a different form of liquidity without taking on new debt.
Finally, we must look at Brazil, which presents an extreme case of how the introduction of a HELOC can offer a vital financial lifeline. This is Brazil, high-interest lifeline.
The consumer interest rate environment in Brazil has historically been, well, brutal. If you're using revolving consumer debt, the rates often hover above 200% per year. And for credit card debt, they can sometimes surpass 430% per year.
That's a crippling level of interest. It makes basic debt unmanageable. As a direct result, almost 80% of Brazilian families ended 2022 in debt, a record high. The need for low-cost debt is an acute national crisis.
Despite this urgent need, the first HELOC product was only authorized in June 2023 by the fintech illiquid. The market potential here is enormous, estimated at BRL 420 billion. That's over $75 billion, which represents a significant portion of all property-guaranteed operations.
And here's the impact that makes this a game changer. Illiquid's HELOCs offer massive savings, with rates around 95% lower compared to typical revolving credit lines. The introduction of this one product promises to enhance financial flexibility for millions, significantly reducing borrowing costs and giving homeowners a powerful tool to escape outrageously high-cost consumer debt. In an environment like Brazil, the HELOC isn't a luxury. It's a necessary mechanism for financial stability.
We've covered the mechanics, the global landscape, and the products themselves. But we need to be clear. Unlocking equity is not free. These instruments are highly valuable, but they come with a distinct set of costs and, more importantly, a philosophical trade-off. Let's start with the costs of accessing equity fees.
It's so crucial for you, the listener, to factor these transaction costs into the total cost of borrowing. While these loans are attractive because of their lower interest rates compared to unsecured debt, they come with a whole variety of associated costs, just like your primary mortgage did.
You'll see a long list of potential charges. Our sources list appraisal fees, which determine the value of your collateral, originator fees, which are the bank's cost for setting up the loan, title fees, stamp duties, arrangement fees, and closing fees, all necessary to formally register the second lien on the property.
And the fees don't necessarily end once the loan is issued. For fixed HELs, you might face an early payoff fee if you try to discharge the debt ahead of schedule. For revolving HELOCs, you might face an inactivity fee if you don't use the line, or an annual membership fee just for keeping the credit line open.
So even though the interest rate might look really attractive compared to a 25% credit card, these upfront and ongoing transaction costs can significantly eat into the benefit of accessing the capital.
Absolutely. while some fees, like surveyor or valuation fees, may occasionally be waived by the lender as an incentive. In the case of second mortgages or equity lines, you are often paying fees just to renew or update title information every time something changes. The key takeaway is to look beyond the interest rate and really scrutinize the closing disclosure.
And finally, let's address the fundamental behavioral risk, the critical view, erosion of savings. This is the core philosophical critique associated with making illiquid wealth liquid.
This is a complex but vital point. It cuts right to the heart of our discussion about the forced savings plan. While access to equity release products offers homeowners incredible financial flexibility, the ability to deal with a sudden expense or seize an investment opportunity studies suggest that this flexibility can actually harm overall household welfare by weakening long-term savings commitment.
In essence, if the wealth in your house is too easy to access, it stops acting like an untouchable nest egg. It starts acting like a temptation or an emergency backstop that is just too easy to reach. What does the data say about this behavioral tendency?
The data is alarming. The core conflict is between the immediate utility of flexibility and the long-term discipline of commitment. One study cited in our sources is particularly telling. It suggested that the welfare losses resulting from this weakened savings discipline, the money you didn't save because you knew the house was there, actually outweigh the short-term financial gains from flexibility by a factor of 1.7.
Wow, so the loss of savings commitment outweighs the gain of access.
That is a profound finding. The cost of convenience is greater than the benefit of the loan itself.
And furthermore, that same study quantified the market-wide impact. It found that this easy access to withdraw home equity drove a 2.5 percentage point drop in the national personal saving rate. This suggests that turning home equity into readily available cash while solving an immediate liquidity problem systematically undermines the very foundational wealth-building strategy, that long-term savings commitment that homeownership represents for the middle class. It's a fundamental trade-off between today's consumption and tomorrow's security.
That brings us to the end of this deep dive into the $35 trillion anchor of American wealth. We started with the simple accounting identity value minus debt equals equity, and quickly discovered that this illiquid asset is the primary wealth-building tool for the middle class. And it's a phenomenon that holds true across developed economies, from the 70% average ownership in the EU to the staggering 90% ownership and massive wealth concentration in China.
We detailed how this wealth is built through both amortization and appreciation, but also how the illiquidity paradox requires a range of highly complex secured debt instruments, ELOs, HELs, reverse mortgages, and even controversial HEIs to be unlocked. And we saw how the history of these products spans from the crisis-inducing boom and bust in the U.S., mitigated by strict regulation in Canada, to the massive potential for financial relief they offer in high-interest environments like Brazil.
The fundamental concept we took away is the dual nature of home equity. It is a vital generational wealth source, providing undeniable security for retirees and a foundation for the next generation. But it is also a massive, tempting pool of collateral that, when tapped too aggressively, has historically fueled major financial crises and, perhaps more subtly, risks weakening the financial long-term savings discipline of the homeowner.
So here is the final provocative thought for you to consider. If home ownership is the great American and global forced savings plan, then the relentless innovation in equity release products is essentially an effort to turn that locked, illiquid savings plan into a readily accessible revolving checking account. We have perfected the science of turning illiquid secure asset value into liquid consumption capital. The ultimate question for you, the homeowner, and for the global economy is, what is the long-term cost of that conversion when security becomes too easy to spend?